On 8th of July, the Reserve Bank of India asked lenders to switch from Libor or London Interbank Offered Rate to other alternative reference rates by December 31st, 2021. Libor rates are interest rates on short-term loans used by banks dealing in international debt instruments like bonds and derivatives like currency swaps and interest rate swaps. But after the 2007-8 scandal in which banks were found manipulating the rate, the global transition became necessary. By now, almost all Indian banks dealing in foreign exchange are ready with the transition to alternative reference rates. Some of the popular choices for alternative reference rates which banks are left with follows: SOFR or Secured Overnight Financing Rate. This is based on transactions in the US Treasury repo market. SOFR is widely used as a substitute for Libor in dollar-denominated loans and derivatives across the world. Another option is Sterling Overnight Interbank Average Rate, also known as SONIA, which is widely used for unsecured transactions in the British sterling market. Business Standard spoke to Siddharth Purohit, who is an equity analyst at SMC Global, to comprehend the impact of this move on the way banks deal in international contracts, among others. Let's find out.
Libor is the most accepted global benchmark rate for lending and borrowing across the globe, and also billions of dollars worth of derivative transactions happens based on the Libor rates. Now, the fact is that probably the underlying market that Libor is derived from is no longer used in a significant volume in the recent years. That is one part. The second part is that the Financial Conduct Authority of UK believes that the way Libor is calculated in practice is no longer complies with internationally accepted principle for a robust interest rate benchmark. So these are the two factors based on which the Financial Conduct Authority of UK has given a notification that the banks and financial institutions in UK will be no longer required to submit their rates or the rates at which they used to lend and borrow, which was basically the the average was taken as the Libor rate. So from 31st of December, the FCA UK has asked not to submit this. That means the Libor rates will not be available globally in a wide way after that. That's why the global regulators across the large developing countries, including Reserve Bank of India, has said in a notifications that Indian banks and financial institutions should start looking for a more accepted kind of rate or alternate reference rate. That's why probably there is a time frame that RBI has given till 31st December. But even the FCA, the Financial Conduct Authority of UK, has given a further relaxation that based on different currencies that people enter into in terms of transactions, right? So maybe Libor rates then not only in terms of euro or pound sterling, even in USD, Japanese yen, Swiss franc, and all. So there is timeline for all to to migrate. So the existing contracts can be carried on. But what the global banks are saying is that, including RBI, that incrementally that no new contract should be entered, that should be avoided, and probably over a period of time that all the banks will have to migrate to a new rate, and see the rates will not differ materially. Let's say Libor plus 200 basis point is one contract that one a bank has entered, and the alternate reference rate is found out to be something similar rate, and I get 200 basis point more than that. So the rate for the lender and borrower will not differ much, but it is the migration process that will take some time, maybe in terms of some operational issues. So till that time, this contracts will remain valid, and till that time, all the contracts are valid, and it is only the incremental that contracts that RBI and other banks want that should be migrated. It's not the existing. So existing that's why there is a timeline till 31st December. And let me tell you that most of the Libor contracts are done on a short to medium term contracts. It's not a very long term contracts like 5 year, 10 year. That's why probably over a period of 1 year you will see that most of the banks globally, including India, would have already migrated. Initially, there will be confusion and difficulties, no doubt, because for years altogether, everybody on this planet has been using Libor as a benchmark rate. So the new rate has to be, a consensus has to be drawn, which is to be used. But as I told you, that SOFR being one of the primary benchmark rate in US could be more likely be accepted as a new benchmark rate, and hence there should not be much of trouble beyond a period of time. But initially, yes, there might be some within trouble that might happen, and yes, all the banks will also have to recalibrate their maybe the system process, and there might be some initial cost process that might delay. But things will not materially change. That's what I believe as far as the way international banking is done. It might be a change in the process. It will not differ as far as the interest rate that every that is prevailing in every economy is not going to get impacted because of this. It's just a process that is being changed. So I don't think it is a point of worry for the lenders and borrowers in a big way. Yes, initially there will be some confusion when there is a new benchmark that is accepted globally. But to my understanding, I don't think that life will change materially for lenders and borrowers, or it will impact the profitability of any bank or corporates. I don't think so.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.